Okay, so you want to own a luxury empire. Maybe you picture a glass tower in Paris, your name on a handbag, and a line of people outside a boutique on Fifth Avenue who have been waiting months just to hand you their money. That image is not wrong, but it is dangerously incomplete. Because here is the thing about luxury that nobody tells you before you get inside it. The business does not work the way every other business works. The rules are inverted. The logic is backwards. And the moment you try to run a luxury company like a normal company, you will destroy the very thing that makes it worth anything at all. By the time this video is over, you will understand exactly how the economics of a luxury empire actually function, why the most important product these companies sell is completely invisible, and why making your products cheaper could be the single fastest way to go broke. Let us start with the most basic question. What is the customer actually paying for? Take a standard Hermes Birkin bag. In 2025, the entry-level version in basic calfskin leather retails somewhere between $13,000 and $16,000, depending on the market. Financial analysts who have broken down the physical cost of producing that bag estimate the raw materials and the labor come to roughly $800. That includes the leather, the hardware, and the hours a single artisan spends hand-stitching the bag from start to finish. So you have something that costs around $800 to make and sells for $13,000. That is a markup of over 1,600%. In any other industry, that number would require an explanation. In luxury, it is the business model. Now, before you assume this is simply greed dressed up in nice packaging, let us actually think through what is happening here. Because that gap between $800 and $13,000 is not empty space. It is not fraud. It is one of the most carefully constructed economic systems in the world. And understanding what fills that gap is the entire point. The first thing to understand is that luxury goods are what economists call Veblen goods. Most products follow a simple rule. When the price goes up, fewer people buy them. Veblen goods work in reverse. When the price goes up, demand can actually increase. The reason is that for these products, the price itself is part of what the customer is buying. A Birkin at $300 is not a bargain version of a Birkin. It is something else entirely. It does not carry the same signal. It does not carry the same meaning. And in luxury, meaning is the product. When someone buys a regular shirt, they are buying a piece of clothing. When someone buys a luxury shirt that costs 8 times as much, they are buying something different. They are buying a signal to the people around them about who they are. They are buying membership in a particular kind of cultural story. They are buying craftsmanship that took decades to develop. They are buying access to something that is, by design, out of reach for most people. The object on their arm is just the physical carrier of all of those things. This is why luxury companies are not really manufacturing physical goods. They are manufacturing meaning. And meaning, unlike leather, has no natural ceiling on its price. So how do you manufacture meaning? The first tool is scarcity. If everyone can have something, it stops meaning anything. The entire signaling value collapses. So luxury companies do something that looks bizarre from the outside. They deliberately cap how much they produce. They do not try to meet all the demand in the market. They deliberately create more demand than they are willing to supply. Hermes does not make as many Birkin bags as people want to buy. The waiting list for a standard Birkin at a boutique can stretch to years. And that waiting list is not an accident of production capacity. It is a strategy. When something has a waiting list, it tells the world that other people want it badly enough to wait. That makes it more desirable to the next person, not less. Chanel has raised the price of its classic flat bag from $5,850 in 2020 to $11,300 in 2025. That is a 93% price increase in 5 years. During that period, demand did not collapse. In many markets, it held steady or grew because each price increase made the bag feel more exclusive, more unreachable, and therefore more desirable to the people who could still afford it. This is the central economic paradox of luxury, and you need to understand it before anything else makes sense. Higher price does not suppress demand. In the right context, with the right brand, it amplifies it. Now this brings us to one of the most controversial practices in the entire industry. If scarcity is the most important asset a luxury brand has, what do you do with the products you make but cannot sell? In 2018, Burberry, the British fashion house, reported that it had destroyed over £28 million worth of unsold merchandise in a single year. That includes clothing, accessories, and perfume. They incinerated it. The reaction from the public was outrage. You have people who cannot afford a coat watching a company burn coats. But the economic logic is brutal and precise. If Burberry discounts its unsold stock, 2 things happen. First, customers learn that if they wait long enough, luxury eventually goes on sale. That expectation destroys full-price demand permanently. Second, discounted Burberry ends up in the hands of customers who cannot normally afford Burberry. The brand becomes more common, and once a brand becomes common, it loses the exclusivity that justifies its price. The £28 million in burned inventory was the cost of protecting the pricing power of everything else the company would ever sell. Since then, regulation in the European Union has made the destruction of unsold goods increasingly restricted. The EU's E-Code sign for sustainable products regulation is pushing companies to rethink this. But the response has not been to flood the market with discounts. Luxury companies have responded by making their production quotas tighter from the start, using private client allocation systems, and managing supply before it becomes a problem rather than after. The principle has not changed, only the mechanism has. This connects to something called the luxury pyramid, which is how every serious luxury empire structures its product portfolio. Picture a triangle. At the very top, the apex, you have the most exclusive pieces. Haute couture dresses made entirely by hand, high jewelry with rare gemstones, bespoke commissions that take months to produce. These items are priced beyond what all but the wealthiest people on Earth can consider. A Hermès crocodile leather Birkin bag in exotic skin sold in 2025 for $64,000. A Patek Philippe Nautilus Ref 5711, now discontinued, trades on the secondary market for between $110,000 and $165,000. These items at the top of the pyramid do not make most of the company's money. They make most of the company's prestige. And prestige is what makes everything below them worth buying. In the middle of the pyramid, you have the core business, the standard leather handbags, the classic watches, the signature ready-to-wear clothing. This is where the bulk of revenue lives. These pieces borrow their credibility from the items above them. The reason a standard Chanel flat bag at $11,000 feels like a luxury purchase rather than an overpriced bag is that somewhere above it in the pyramid, there are Chanel pieces that cost 100 times more and exist purely to prove the brand is capable of the extraordinary. At the base of the pyramid, you have the entry-level products. Perfumes, sunglasses, small leather goods, lipstick. A Chanel perfume might sell for $150. A Louis Vuitton keychain for $250. These items are mass-produced at industrial scale and carry extremely high gross margins. They also serve a critical strategic purpose. They let aspirational customers into the brand ecosystem at a price they can afford. Once someone is wearing your perfume, they feel a connection to the brand. That connection, if carefully managed, can eventually move them up the pyramid. The entry-level product does not generate the company's most important value. It generates the customer pipeline. Now let us talk about where these products actually get sold. Because the store itself is part of the product, a luxury boutique is not a shop. It is a theater. The architecture is a statement. The lighting is engineered. The sales staff are trained not just to complete transactions, but to create an experience that makes you feel as though the brand is doing you a favor by letting you buy something. The physical space communicates wealth, taste, and cultural authority. And where that space is located matters enormously. Retail space on Fifth Avenue in New York, specifically the stretch between 49th and 60th Streets, rents are approximately $2,250 per square foot per year. New Bond Street in London and the Ginza district in Tokyo are in the same tier. These are among the most expensive retail locations on Earth. No brand occupies those locations because the foot traffic math works out on a spreadsheet. They occupy those locations because being there is a statement. A Louis Vuitton on Fifth Avenue across from Cartier and Tiffany is communicating something very specific about where it sits in the hierarchy of the world. That location cost is not a retail expense. It is a marketing expense. It is the price of being perceived as belonging to that class of thing. And those stores are not just selling to people who walk in off the street. They are selling to every person who walks past and sees the logo. They are selling to every tourist who photographs the facade. They are selling to every editor who includes them in a fashion story. The store is the most expensive advertisement the brand runs. If you are finding this useful, please hit the subscribe button and give this video a like. It helps more people find this content, and there's a lot more coming. Now let us zoom out from the individual brand and look at who actually controls the luxury industry at the top level, because the answer might surprise you. The global luxury landscape is dominated not by independent fashion houses run by their founding families, but by massive corporate conglomerates that own dozens of brands simultaneously. The largest of these is LVMH, which stands for Louis Vuitton Moet Hennessy. LVMH owns Louis Vuitton, Dior, Givenchy, Celine, Fendi, Bulgari, Tiffany & Company, Tag Heuer, Moet and Chandon, and dozens of other brands. Its revenues in 2024 exceeded €84 billion. The second largest is Kering, which owns Gucci, Saint Laurent, Bottega Veneta, and Balenciaga, among others. The third major force is Richemont, which owns Cartier, Van Cleef& Arpels, IWC, Jaeger-LeCoultre, and Piaget. These conglomerates exist because of economic scale. Running a luxury brand requires enormous investment in flagships, in heritage marketing, in craftsmanship infrastructure, in global logistics. A single independent brand would struggle to fund all of that. But when you are LVMH and you control the same premium retail locations in 60 countries, you can negotiate leases across your entire portfolio. When you control the tanneries that supply the leather, you create supply chain advantages that independent competitors cannot match. The parent company handles the capital, the logistics, and the real estate. Each individual brand handles its own identity. This decoupling is important. LVMH runs the back end. Louis Vuitton runs the cultural front end. To the customer, Louis Vuitton feels like Louis Vuitton. The conglomerate structure is invisible to them. But financially, the scale advantages are enormous. And this is why, when these conglomerates want to grow, they often do not build new brands. They buy them. Building a luxury brand from scratch is almost impossible. The reason is that luxury brands derive a significant portion of their value from heritage. History cannot be manufactured overnight. A customer paying $15,000 for a bag wants to know that the craft behind it has been refined over generations. They want the story of founding artisans, of design archives, of pieces carried by figures from history. These are not details. They are economic assets. Hermès was founded in 1837 as a harness workshop for French cavalry. That origin story is not just marketing copy. It is the foundation of a credibility claim that no new company can replicate simply by hiring good craftspeople and spending money on advertising. This is why LVMH paid $15.8 billion to acquire Tiffany & Company in 2021. They were not buying the stores, they were not buying the inventory. They were buying 184 years of brand equity, a globally recognized robin's egg blue, and a heritage that has been embedded in American cultural memory for generations. You cannot build that. You have to buy it. But acquiring a brand comes with a dangerous trap. If you buy a legacy house and then immediately start pushing it to grow faster, you risk destroying the thing you just paid billions for. Gucci is the textbook case. By the early 90s, under pressure to grow, the brand had licensed its logo to over 14,000 products sold through department stores and duty-free shops worldwide. The logo lost its exclusivity signal. Gucci went from being one of the most prestigious fashion houses in the world to a brand associated with cheap knockoffs. Revenue collapsed. The family lost control. It took almost a decade of brutal repositioning under designer Tom Ford to rebuild what had been diluted. That recovery required closing hundreds of distribution points, canceling licensing agreements, and absorbing years of reduced revenue. The lesson: expansion beyond the limits of exclusivity is not growth. It is destruction in slow motion. Now let us get into the actual financial mechanics of how these businesses make money, because the margins involved are unlike almost anything else in manufacturing. We already established that a Birkin bag costs around $800 to make and retails for $13,000 to $16,000. That is not where the full picture ends. Once you account for retail real estate, marketing, corporate overhead, and logistics, the operating cost of bringing that bag to market is closer to $4,500 to $5,000. That still leaves a gross margin of between $8,000 and $11,000 per bag. At an operating margin in the mid-20s to low 30% range, which is where houses like Hermès typically operate, this is one of the most profitable manufacturing businesses in existence. By comparison, a standard consumer goods company operates on margins of 8 to 12%. A luxury house operating at 25 to 30% on far higher price points is generating cash at a rate that most industries simply cannot match. This cash funds everything else. It funds the cultural positioning, it funds the flagship stores, it funds the heritage preservation, it funds the acquisitions, and crucially, it funds the investments that make the brand stronger, which in turn support the pricing power, which maintains the margins. The flywheel is self-reinforcing once it is running. But getting it running in the first place requires something that cannot be bought directly. It requires the customer to believe. Let us talk about who that customer actually is, because luxury does not sell to one type of buyer. It sells to at least two very different economic profiles. The first group is what the industry calls aspirational consumers. These are people who stretch to afford the lower end of the pyramid: a Louis Vuitton wallet, a Chanel lipstick. They are earning good salaries, but luxury is a real financial stretch for them. When inflation rises or job markets weaken, they pull back immediately. Their spending tracks the broader economy. The second group is what researchers define as ultra-high net worth individuals, people with liquid assets above $30 million. For this cohort, a $20,000 bag barely registers. and their spending is not driven by salary. It is driven by asset values. When stock markets rise and investment portfolios grow, they spend more. When those assets fall, they pull back. Luxury brands indexed on aspirational buyers collapse in recessions. Brands at the top of the pyramid are insulated from normal economic cycles, but acutely exposed to capital markets. Neither group is immune, but they break in different environments. The geography of luxury spending adds another layer of complexity. Luxury empires do not sell products to countries. They follow concentrations of wealth. In 2023, Chinese consumers account for roughly 35 to 40% of global luxury spending, much of it occurring outside mainland China as wealthy Chinese travelers shopped in Europe, Japan, and Southeast Asia to take advantage of lower prices and VAT refund systems. When cross-border travel was restricted during the pandemic, that spending disappeared almost overnight, and luxury groups reported revenue contractions in the double digits. The lesson for any operator of a luxury empire is this: your customer is not geographically fixed. They move. They respond to currency fluctuations, visa regimes, and tax incentives. Managing a luxury empire means managing a global map of wealth, not a set of country-level markets. Now let us talk about the one thing that luxury companies fear more than competition: the resale market. For most product categories, once someone buys a product and takes it home, the financial story ends, the company got its revenue, the customer got their product, the transaction is closed. In luxury, the story does not end at the register. A 2020 Hermes Birkin in standard calfskin that retailed for $9,400 was trading on secondary market platforms in 2025 for between $16,000 and $35,000. The Patek Philippe Nautilus watch mentioned earlier traded at between 3 and 4 times its original retail price after it was discontinued. These are not investments in any formal sense, but they behave like one. And this resale dynamic feeds back into the primary market in a powerful way. If a customer knows that the bag they are buying today for $13,000 will likely hold or increase its value in the resale market, then the purchase feels fundamentally different. It is no longer pure consumption. It becomes something closer to a durable asset purchase. That psychological shift reduces the friction of spending. It makes the $13,000 price feel more reasonable, because part of that money is, in theory, recoverable. Luxury brands actively monitor resale data. When secondary market prices for their products are consistently above retail, they have the market validation they need to raise primary prices without destroying demand. The resale market is, in effect, a real-time pricing signal telling them how far they can push their own price increases. But the resale market is also ruthless. It does not lie. Products from brands that have diluted their exclusivity trade at steep discounts to their original retail price. The market can tell the difference between genuine scarcity and manufactured hype. And when it decides a brand has lost its edge, the numbers show it immediately. This brings us to the role of culture, which is where the financial story starts to look less like accounting and more like something stranger. Luxury brands do not primarily advertise to their target customers the way a normal company would. They do not run television commercials saying, "Buy this bag." The strategy is more indirect and, frankly, more ambitious. They try to insert their products into the fabric of culture itself, so that the culture starts recommending the brand on their behalf. When a luxury house dresses a major film star for an awards ceremony, that is not a simple endorsement deal. The goal is for the image of that star, in that moment, carrying that bag or wearing that watch, to become a cultural reference point. When people see the bag afterward, they are not just seeing a bag. They are seeing an echo of that cultural moment. The product becomes associated with excellence, achievement, and taste, not because the brand said so, but because the culture demonstrated it. The Hermes Kelly bag takes its name from Grace Kelly, who was photographed using a Hermes bag to shield her pregnant belly from photographers in 1956. That photograph appeared in Life magazine, and the association became permanent. Hermes did not plan that moment, but it captured it, named a bag after it, and has been drawing on that cultural capital for almost 70 years. That association cannot be created with an advertising budget. It has to be earned and then carefully stewarded. This is why luxury brands invest in sponsoring museum exhibitions, art foundations, and cultural institutions. They are not doing charity. They are buying proximity to the things that the wealthy class values. When Cartier sponsors a major exhibition at the British Museum or LVMH funds a contemporary art foundation in Paris, the brand gets to sit next to history, scholarship, and creative achievement. That proximity becomes part of what the customer is buying when they spend $15,000 on a watch. The accumulated weight of all these cultural investments over decades is what economists call a competitive moat. A new company can hire the best craftspeople, open stores on Fifth Avenue, and price its products at luxury levels. What it cannot do is accumulate 70 years of Hollywood moments, royal endorsements, and archival depth that turns a brand name into shorthand for everything aspirational people want to be associated with. That gap between what a new entrant can build and what an established house already has is the most valuable asset in the entire industry. It takes decades to build. It can be destroyed in years. And it is completely impossible to see on a balance sheet. Let us bring all of this together and look honestly at what it means to operate a luxury empire. The things that can go wrong fall into a fairly specific set of categories. Economic contractions at the high end of the wealth spectrum hit the top of the pyramid hard and fast. In 2008 and 2009, luxury groups saw revenue fall by as much as 15 to 20% in certain categories as financial markets collapsed and the assets of high net worth individuals shrank. The brands recovered, but the exposure to asset market cycles is real and recurring. Counterfeiting is a structural problem the industry has never fully solved. The global counterfeit luxury goods market is estimated in the hundreds of billions of dollars annually. Fakes do not just steal revenue. They dilute the exclusivity signal. If a Rolex Daytona can be convincingly imitated for $300 and millions of those imitations circulate in public, the authentic watch loses part of its power as a status symbol because the signal becomes ambiguous. Authentication programs, legal action, and technology embedded in products slow the problem but cannot eliminate it. Creative direction failures are a more internal risk. Luxury companies live and die by the taste of their creative directors. When Gucci's Alessandro Michele reinvented the brand in 2015 with a maximalist, eccentric aesthetic, the brand's revenue nearly tripled over the following 5 years. When he departed in 2022, and the subsequent creative direction failed to resonate, sales stalled. The entire financial trajectory of a multi-billion-dollar company can hinge on the sensibility of one creative individual. That is an unusual operational risk that has no parallel in most other industries. Geopolitical disruption is the wild card. Chinese consumers account for roughly 35 to 40% of global luxury spending. Any significant disruption to Chinese travel patterns, consumer confidence, or trade relations between China and Europe creates immediate financial pressure at the conglomerate level. The industry discovered this acutely during the pandemic. It continues to discover variations of it as tensions between major economies rise. And then there is the deepest risk of all, the one that keeps the most experienced executives in this business awake at night. The risk of simply becoming less desirable. Brands can go out of fashion. Heritage can start feeling irrelevant rather than prestigious. A generation of consumers can decide that the cultural associations a brand spent decades building are not the ones they want to be associated with. When that happens, the entire pricing structure is unsustainable, and there is no obvious fix. You cannot advertise your way back to desirability once it is gone. You can only try to rebuild it slowly, expensively, and with no guarantee of success. The final question is the one that every analyst who covers this industry eventually arrives at. Can a luxury empire keep growing forever? The market demands growth, but the business requires scarcity. At some point, these two imperatives collide. The most sophisticated luxury operators manage this tension through several mechanisms. They raise prices rather than units. If you need more revenue and you cannot produce more volume without eroding exclusivity, you produce the same volume at a higher price. Hermès has done this consistently. They also expand into new categories where they can maintain scarcity at a high price point, such as high jewelry or bespoke services, which generate enormous revenue at negligible unit counts. And they acquire new brands, adding revenue at the conglomerate level without stretching any single brand's identity beyond what it can hold. But there is a ceiling. Every brand has a natural boundary of credibility. Push past it and you spend decades trying to find your way back. The luxury operators who understand this and who resist the pressure to maximize short-term revenue at the expense of long-term brand equity are the ones who build empires that last. The ones who do not understand it, or who understand it but yield to quarterly earnings pressure anyway, become case studies in how quickly a 100-year-old brand can unravel. Before we close, if you want to go deeper on how great businesses are built, structured, and run, I have put together a detailed business guide that you can find in the description below and pinned in the first comment. It covers the fundamentals that apply across industries, and it is worth a read. The economics of owning a luxury empire can be summarized in one system, and that system has exactly 6 steps. Controlled scarcity generates intense desire. Intense desire supports pricing power that has no parallel in normal manufacturing. That pricing power creates extraordinary margins. Those margins generate free cash flow that funds stores, heritage, culture, and acquisitions. All of those investments strengthen the brand. A stronger brand generates more desire, and the whole cycle repeats. A luxury company is not in the business of selling expensive objects. It is in the business of building a self-reinforcing machine that converts perception into pricing power. The physical product is real. The craftsmanship is real. The materials are real. But the reason someone pays $13,000 for something that cost $800 to produce is not about any of those things. It is about everything the brand has made that product mean. Luxury is not the business of selling expensive things. It is the business of making people believe that expensive things are worth wanting. If this video gave you something useful, please like it and subscribe to the channel if you have not already. Share it with someone who would find it interesting. It means a lot, and thanks for watching.